Hi, everyone. Welcome to our session. Today, I have Joseph Wang, and Joseph is, he's known as the Fed guy. And Joseph has used to work at the Fed trade table. I want to give Joseph the time to kind of give a brief introduction of himself. And then we're going to get into really interesting, pretty mind-boggling sessions on how rates are created and how the plumbing kind of works and how that impacts like commercial, multifamily lending, and potentially fixed rate mortgages as well. Yeah.
Thanks so much for inviting me. It's great to see you again. It's great to be here. And thanks everyone for getting up so early to come and hear me. So a little bit about me. So I used to be a trader on the Fed's trading desk. Yes, the Fed has a trading. That's how they implement things like quantitative easing when they're buying or selling mortgage securities. It's done to people like me. One of the things that I did on the Fed's trading desk was I studied a lot about the plumbing of the financial system. And also I was involved in publishing SOFR, which as I understand is becoming increasingly important in the real estate world. And tell you, so today I could talk to you about what SOFR is, what the repo market is, and how the Fed implements monetary policy. So as we know that rates are going higher, what does that mean? And how does that work throughout the financial system? And how might that impact your mortgage business, your real estate businesses? So, and of course, happy to take any questions in the audience going forward as well.
Yeah, and then I think we have a pretty intelligent audience over here today. So put your question in the Q&A, and then we kind of address this as we go. So I will have a lot of questions for Joseph as well. So first of all, as Joseph kind of mentioned before, SOFR, why is the SOFR important, right? So I think for some of our listener over here who is not into the plumbing of multifamily, like, so what just happened this year? A big thing has just happened in terms of mortgage lending. Typically in commercial multifamily lending, we use this base point, like if you're using a bridge loan or any floating rate, there's always a base to it. So we typically use the Libor. Libor stands for, I think it was a British, I don't know, like Joseph will be explaining this more.
London Interbank Offering Rate.
Yes, so Libor has been around for a very long time. Technically, it's supposed to be based off a British market, but however, Joseph has shared with me before, that's not necessarily so. But after more than 10 years of all the commercial lendings, et cetera, based on Libor, this year, what just changed is I'm getting term sheets. What I'm getting is everybody is based at their floating rates based on SOFR. So what is SOFR? We don't really know, right? So I think as we do real estate investing, it's important to know a little bit of the plumbing of the rates, how they're getting controlled in the back end. So when a news flash that says, oh, Fed's hiking rates over here, how is like directly impacting to your mortgage? So we can interpret it, and ideally we can kind of predict a little bit forward as well to have the necessary measure to protect ourselves. So Joseph, can you explain to us what is Libor, what is SOFR, what are they based off? And I know that you had these like great slides that you have presented before, and how it all ties in with like 10-year treasury and repo markets.
Yeah, so Libor is basically, for the most part, for many decades, the global standard in dollar interest rates. When people are talking about like a rate that has credit risk, they're talking about Libor. That's why it appears on all your contracts. In the beginning, Libor was basically a rate for banks in London. So if you're a big bank in London, what they would do is they would ask a panel of them, if you had to borrow in the dollar markets, what interest rate would you pay? And they take a panel of all these banks, take their self-reported rates together, lop off the extremes, and you'd have Libor. And that was basically a benchmark rate of where a big bank would borrow if they needed to borrow dollars in unsecured market. That rate became extremely influential. It was used not just in commercial real estate, but it was also used in corporate debt and in all sorts of kind of benchmarks. During the Great Financial Crisis, there became some concern that maybe Libor was not a reliable rate. There were some reports that perhaps some people in some banks were submitting Libor in a way that was not straightforward, and they were doing so to benefit themselves. For example, there were reports that some banks were submitting a lower Libor than they should have because they had other positions, derivative positions, that would benefit from a lower Libor. So they were getting together and kind of, I guess, reportedly manipulating this. rate. And so the official sector, let's say the Fed, not just the Fed, but the global regulatory committee, people in the Bank of England and people, let's say the BIS, they all felt that this was a less reliable rate. So they wanted to reform LIBOR to make it into a rate that was more trustworthy. And the Fed went about trying to figure out what kind of rate do they want to be a reference rate. And after a lot of discussion, what they landed on was SOFR, which is a repo rate. And in a moment, well, actually, I'll just tell you what repo is. Repo is basically a secured loan that's backed by a treasury collateral. So for example, if I had a 10-year treasury security worth $1 billion, I could repo that out into the repo market and get a cash loan with that collateral. Technically, it's called repo because the way that the secured loan is structured is that you sell that treasury to someone simultaneously with a promise to buy it back, let's say the next day, at a slightly higher price. That slightly higher price is what's considered the interest of that loan. People like repo because under bankruptcy law, it's a bit more creditor friendly. If you do a secured loan, a proper secured loan, and then the person you lend to goes bankrupt, then you end up in bankruptcy court under the automatic stay, then you're stuck. You're going to have to go to bankruptcy court and it's expensive and you have to wait for things to pan out. But if you do a repo transaction, you walk away with the collateral, so it's easier. So lenders like to do repo loans. Now, the repo market is a ginormous market. So just in the US, just private sector repo is about $3.5 trillion a day. Now, SOFR, which is a subset of that, is $1 trillion in private transactions every day. So it's a very, very deep market. And if it's a deep market, it's a market that's very difficult to manipulate. Now, another big difference is that SOFR is done with real transactions. Libor, like I mentioned before, was just a group of the banks just reporting what they think they can borrow at. There's no real transaction under it. And in fact, the actual transactions that banks do every day is very low. Say, every day you come up with a Libor rate, that's the bank reporting what they can borrow at. But the actual borrowing done by these banks is maybe about 30 billion a day. So you're going to have this entire universe of loans based on a reference rate when the underlying transaction volumes are very small. SOFR is completely different. The Treasury repo market, $1 trillion a day. So it's impossible to manipulate. So that's why the Fed chose it. They felt that it was more secure. But more importantly, though, it's a market that the Fed controls completely. Now, Libor, as all you've seen, for example, during 2020, Libor can do all sorts of things. It can spike higher, and then it can suddenly move very lower. It can be volatile. Fed doesn't have a lot of control over Libor, but SOFR is a whole nother matter. SOFR, the Fed can control very well. It does so because it has two tools to control SOFR. It has something called a reverse repo facility actually, I'll just make it this easier because the Fed is willing to lend and borrow in the repo market in basically infinite quantities. So if SOFR gets too high, the Fed will come in and be willing to lend infinite amounts of money into SOFR. That keeps a ceiling on it. And if if SOFR is too low, the Fed will step into the market and be willing to borrow infinite quantities of it. So that means that anyone who's willing to lend who can just lend to the Fed. So that puts a floor on rates. So this kind of, for the private sector, moving to SOFR has the benefit as just cutting out a lot of the tail risk. So, if you're borrowing with Libor, it could spike. SOFR can't spike. So that's one benefit there.
So it's kind of like it allows the Fed to kind of potentially manipulate that rate. It could be more stable. You would guess the Fed want to stabilize these rates. But it kind of turned it into a little bit more of a big government control rates.
Absolutely.
Kind of
so
yeah. So do you see some side effect to that?
Well, so here's the thing. Let's say you're making a Libor loan. And so think about the SOFR. So Libor and SOFR, big difference. Libor has credit risk. SOFR does not have credit risk. Because if you're lending against treasury collateral, you don't have credit risk. It's a risk-free rate. So let's say bad things happen. That's why Libor goes higher. That's why SOFR goes lower. So that's a good thing for you. However, if you're a lender and you know that this is how it works, then beforehand you might add a slightly higher spread to Libor to your SOFR loan because you know that if something happens, SOFR is not going to go the direction you want. So let's say you're a lender lending based on SOFR, and there's another COVID panic or something like that. Your risk increases, right? But SOFR is going to go lower. So keeping that in mind, maybe you might want to increase your spread over SOFR at the beginning. So I think this is all new, so it's not clear how people react yet. But you made a really good point, though, about whether or not this is manipulated rate, and it absolutely is. But here's the thing, though, all short rates are manipulated. So when you look across the rate universe, I would divide it into a couple segments. The first would be the short rates, which includes SOFR, let's say up to like 5 years. And then in the middle is 5 to 10, and then 10 and beyond. Within 5 years, those rates are all set by the Fed. And the Fed is able to set this rate because it's willing to borrow unlimited amounts of money at whatever rate it wants. So today, let's say the rates are around zero. The Fed is willing to borrow basically unlimited money at zero. When the Fed raises rates, let's say it raises it to 1%, then the Fed says, I'm going to borrow money in unlimited quantities at 1%. When the Fed does that, all the private investors say that, I can either lend to the Fed at 1%, or I don't ever have to lend below 1%. So that's how the Fed controls short-term rates. Now, I say 0 to 5 years because there's an expectation of how the Fed will move their overnight rate, right? So if this Fed says, I'm going to keep rates to zero for like 2 years, then for rates 2 years out, everyone believes the Fed, and that means the 2-year rate is going to be around zero. So the Fed has a lot of control over the first 5 years, and they are completely manipulated, and they've always been. The longer dated rates, let's say beyond 10, that's not really controlled by the Fed. The Fed has to do that indirectly. The way that they try to do that is for tools that we've all heard of, like quantitative easing or mortgage purchases.
Yeah. Can you explain these terms a little bit more for our listeners over here? Yeah.
Of course. So what happens? So in the short-term rates, the way the Fed controls short-term rates is basically offering to borrow unlimited quantities overnight, right? And because the market participants have a view as to where that overnight rate will be over the next few years, they can easily price rates up to, let's say, 5 years. Beyond that, no one knows. So let's say rates are at zero, and the Fed says, I'm really worried about the economy, but my rates are already at zero. I'm not going to do negative. How do I stimulate the economy? So what the Fed ends up doing is they're thinking, I want to make, let's say, 10-year rates go lower. I want to make mortgage rates go lower. How do I do that? I just buy a lot of treasuries. I buy a lot of agency MBS. And when the Fed buys this, the prices go higher, as all of you know, then the yield goes lower. And that's what they've been doing for the past, since the post-GFC world. And now, though, they're going to reverse all that. And I know most of you are in the commercial space, but if you're looking at, let's say, the residential space, you've noticed that the residential mortgage rates have gone higher. That's because they're not just going to stop doing QE, they're going to reverse that and start selling mortgages in the coming months. And I think the market is trying to brace for that.
Gotcha. So when you say they try to sell mortgages, that then Fannie and Freddie loan is actually what that is.
Yes.
So they basically potentially, let me kind of explain this a little bit more to see if I got it right. So potentially to manipulate the rates to be lower, they will basically do a lot of lending, right? Correct? Do a lot of lending through the agencies, which is Freddie and Fannie. Most of the residential loans are kind of on Freddie and Fannie anyways. But I think on the commercial sector, there's also depends on the amount. I think during COVID, we saw that all the bridge loan was pulled back. So private lenders are pulled back. Then the Freddie and Fannie are the only one in town. So they did a lot of lending during the COVID time. Conversely, last year, for example, when the COVID recovery happens, when the rents keep going up, and we see Freddie and Fannie are just not competitive compared to the bridge lending that's out there. So we see a lot less of the Freddie and Fannie borrowing from the commercial side. But I think on residential, that they're still probably the largest lender, right? So does that just mean that they're gonna potentially lend less because they want to move the rates up? So potentially there'll be less of mortgages that they would lend through Freddie and Fannie. Like, is that kind of what we're looking at for
Yeah,
residential world?
so let's say the Fed bought an agency MBS. You can think of it as the Fed lending.
Mhm.
So they have about $2.5 trillion in residential agency MBS on their balance sheet. That's kind of like
Yeah.
the Fed lending. Now they're going to sell
Mhm.
some of those.
Yeah.
And so what that happens is that means someone else who's not the Fed is going to have to step in as the lender. Now that means you're going to have a higher price, because when the Fed buys things, they don't really care about the price. They're just trying to push the price lower. Now they're doing the opposite. They want rates to go higher because listen, the mortgage, say the housing price is going up 20% a year. That's not normal.
Right.
That's obviously not supposed to be how things work. It's great if you have a house. I mean,
Right.
I'm happy, but other people, if you don't have a house, that's not good, right? And we
Right.
want housing to be affordable so everyone can have a
Right.
home.
Yeah, exactly. So that's really interesting, because I'm deriving from like just this simple conversation we had over here, is that as the rates go up, not only the rates is going up, but potentially there may be less, because we do know in the commercial space, our lender always tell us like we're tapped out because we hit our quota, right? So what that means is like, or Freddie and Fannie hasn't hit their quota, because there is a quota. And then, I think it's during COVID or pre-COVID, there was 1 year, I think it was 2019, literally they hit their quota halfway through the year. So made lending a lot more difficult later on, because they're like, we hit our quota, whether if the Fed's deciding to lend more, or they just say, we don't lend this anymore. And all of a sudden you have this like 800-pound gorilla in the rooms that says, I'm not doing deals anymore. So then it does increases the rates for the bridge loans or other lenders, local community banks, etc. And so it is a double whammy effect. I feel like there is. So that may be the market that we're looking at moving forward. I know the Freddie and Fannie has done very little business in last year. I think they really encourage people to borrow Freddie and Fannie, but the leverage is typically very low. So in commercial space, we didn't really want to borrow Freddie and Fannie. But this year, we're start looking at some Freddie and Fannie, because that's fixed rate loan. Potentially they give an option for fixed rate loan versus a floating rates. Can you explain a little bit about, like the whole 10-year treasury? You talked about a little bit about the long-term rates. And then as Fed has signaled, hey, I'm going to increase my short-term rates, because that's the market that they can control. But the long-term rates is not very much controlled by them. And then what is it driven by? What is the long-term rates are driven by?
Yeah, that's a great question. It's a story of like a thousand papers. So basically it boils down. So you have a couple of schools of thought here. People think of it, it's just the market's expectation of what the path of the short-term rates are. That could be, but most people think of it as just supply and demand. It's really basic. On the supply side, you have the U.S. Treasury. How much deficit spending are they going to do? And where are they going to issue debt? You can do a whole bunch of deficit spending and then just issue debt, let's say 3-month debt or 6-month debt in the money markets, and that's not going to affect the 10-year at all. Or let's say you can do $1 trillion in deficit spending and issue a whole bunch of 10-year treasuries. That surge in supply is going to push the rates higher. So that's the supply side of what happens. But just to be clear, so that's treasuries only, but treasuries and other markets are very much intertwined. So for example, let's say there's a huge refi boom, or maybe another huge housing boom, and there's a lot of agency MBS that gets issued. A whole bunch of people take out mortgages, they go to buy their house. Fannie Mae securitizes those mortgages and they get sold onto the market. A huge surge in like other comparable assets also puts upward pressure on all interest rates, because a lot of people decide between whether or not I should buy treasuries or agency MBS, right? So this whole interest rate market is related. So it's a supply of what we'd say duration in the market. On the demand side, it's basically who's buying treasuries. Yeah. So when you're talking about 10-year treasuries, it's a really, really special asset, because treasuries are, if you really think of it, a 10-year treasury is basically just like $1 billion in treasuries is like $1 billion bill that pays
Yeah.
interest. I say that because we don't usually think of it that way, but if you have a dollar bill, it's printed by the government. If you have a US Treasury, also printed by the government, there's no credit risk. It's also very liquid. And so there's a huge range of investors in the world who think that way. If you're $1 billion asset manager and you have a bunch of cash, you can't just put it in JP Morgan, right? That's a lot of credit risk. People can't take that. And so you buy treasuries. And it's the same for, let's say, if you're a huge sovereign fund, like People's Bank of China, you have like $3 trillion. You can't just put that in the bank. You have to put that in treasuries. So demand for treasuries is global and very strong. Part of it is regulatory as well. The government forces a lot of investors to buy treasuries as safe assets. So it's that interaction between supply and demand that makes that serves rates. Now, holding that all constant, there's the Fed. And I say the Fed now because the Fed, until very recently, was buying like $80 billion of treasuries a month. And that's a very big source of demand that's basically going away. So when that demand goes away and you have even more issuance coming out, this year, the US Treasury is estimated to issue about $2 trillion in debt. So that's a lot of supply for a treasury market whose overall size is about $23 trillion. So the expectation, I think, is for rates to go higher. And I think that's not hard to see. Rates are very low. We have inflation at 7.5%, and we have enormous amount of supply coming online. So that I think that the overall expectation would be just higher rates because of those factors.
Gotcha. And then the overall 10-year treasury, that's interesting because you said before the Fed was buying 80 billion a year, right? So
a month, actually.
A month. Sorry, that's
insane.
A lot.
Yeah,
a month.
it's a big number.
Yeah, a huge number. Why did they stop buying? And now why would the Fed buy 80 billion a month?
So
because the treasury is basically, let's say, the government spending, like, okay, we're gonna do a big package on healthcare or whatever, like and that's created the debt, right? And that's what the issue of a treasury is. And then if government's already borrowing money, how could Fed buy the debt? How does that work?
So you could actually think of it another way. So let's say the government, this is an emergency, COVID emergency, I'm going to spend, $1 trillion in emergency spending.
Yeah.
Okay. Then I issue debt, Fed buys it, right? So Fed sends the government cash and the government spends it. So you put it all together, you can think of it as the government basically just printed a bunch of money out of thin air to buy stuff.
Yeah.
And when you do that for like $3 trillion, which is what we did, you get inflation, right? It's very simple. Print $1 trillion, spend money, inflation. So that's kind of what happening in the economy. Now the Fed did this because one, it wanted to be a team player and support what was perceived as an emergency. Yeah. And two, it wanted to keep longer term interest rates low, just to stimulate the economy. And it did that. And then it realized, well, the economy is doing okay. In fact, we have enormous inflation. Nobody can find people to hire. Housing prices going up 20, 30% a year. Right. We don't really need to do this emergency stimulus anymore. Okay. Right. So their intention is to make rates go higher to cool things down. Right.
So then just stop buying the treasuries. That's one way to do it.
That is one way to do it.
And then when you look at the global economy, it's very interesting when you talk about that. How is global impact on the long-term rate? Do you think like the global economy has bigger impact on the long interest rate, or does the US economy does the predominant impact to the rates here?
That's a really good question. And I think the world really changed in the post-financial crisis world, because post-financial crisis world, central banks began to do very interesting tools, not just quantitative easing, but negative interest rates as well. Right. So if you look in Japan, they have negative interest rates. If you look at the Eurozone, they have negative interest rates as well. What that means is that if you're a pension fund or any kind of huge investor in Japan or Eurozone, your money is being set on fire. And so you look at us, you look at the US and be like, oh my gosh, they have positive interest rates. That's like a gift from heaven, right? I got to invest in the US. And so you can have 10-year rates lower than let's say what inflation would imply, because you have a lot of people abroad who have negative interest rates and want to buy that because it's so much better than what they can get at home.
Got it.
So it's very misleading to look at interest rates and just in a way of, let's say, growth and inflation, because we have a global economy, like you mentioned, and what other people do, specifically what other central banks do, have an impact on the demand for U.S. treasuries as well.
Definitely. We have a question here. So Mark was asking, what would be the alternative to the Fed, if any? It's a very loaded question.
Yeah. So, well, I think it's not so much whether there is a Fed or isn't a Fed. It's how good should it's like anything else, it's like whether we should not have a government or it's not so much whether we should have a government or not. It's what kind we should have. Obviously having a good central bank, I think, is better than having no central bank. And I'll tell you why. So you can think of this as kind of like a, almost an evolutionary thing. You have countries all over the world. In the beginning, no one had central banks, right? But eventually everyone evolves towards this kind of institution because it has a role. So if you think about the time in the US before there were central banks, every now and then you would have financial panics.
Right.
And what happens when there's a financial panic? Well, everyone takes money out of the bank. Banks fail. People lose everything. So a central bank appears to be a lender of last resort to help the banks through their liquidity problems. It's like giving people a bridge loan, right?
Right.
So because sometimes panics happen, you could have a bad harvest. It could be psychological. There could be war somewhere. You have a temporary liquidity problem, not a solvency problem. You can have a central bank to step in and give you a bridge loan, and that's really helpful. It's much better than letting everyone just implode. Now, central banks today do a lot more than that, and I think it's a good question to ask whether or not a central bank should be involved in climate change, whether or not it should be trying to solve all these other social issues, right? But I think the institution of a central bank, it's a good thing to have.
Yeah, as long as it's staying, politically neutral, I think it's potentially a better thing to be having there. And so I guess everybody's always having this question, would interest rate increase this year? I think we're pretty clear that the interest rate likely is going to increase short term in the next 2 years or so. Do you agree with that, Joseph?
Yeah, so the way that this works is that Fed doesn't surprise the markets. So it's going to tell you whether or not it's going to raise interest rates far beforehand. And so it would definitely raise interest rates in March. That's really not a question. But here's the thing, though. The impact of interest rates don't actually happen at the announcement. They happen whenever it's hinted. Because whenever the Fed starts to hint that they're going to raise interest rates, it gets priced into the market. So right now, for example, if you wanted to borrow for 2-year time or 1-year time, it's already above 1%, right? The market is already priced in an expectation of Fed hiking interest rates. So the market expects that the Fed is going to hike, a few times this year. And I think that's the right conclusion. I understand that many people think that the stock market, blah, 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 so forth. But if you don't understand, first and foremost, the Fed is about employment and inflation. And inflation is just too high. And the Fed has political backing to start hiking rates, even if it does hurt some asset prices. So they're definitely going to do that. It's unambiguous, and I think my own view is probably going to be more aggressive than most people expect.
Gotcha. Yeah, because so then to this point, I think there are different tools in commercial lending that if you were to buy a bridge loan, basically a property like apartments, for example, using bridge loan, there are things that the lender makes you purchase, which is called a rate cap. Essentially, it's almost like a insurance that you prepay. It's almost like a prepaid points, right? So you say, okay, I'll spend $1 million. That's a lot, but $1 million, and I'm going to purchase a rate cap for this 3-year duration and cap the rates at 0.25%. In the past, we have purchased that for a lot lower amount. Last year, we did that. I think this year we start seeing these rate caps that are become astronomically more expensive with a lower rate. So do you think it's a wise, like how would people evaluate whether or not they should be purchasing rate cap? Because typically the package comes in about 2 to 3% rate cap is what you must purchase. And then 2 year versus 3 years, I think these are the options that for you to purchase. But you can always choose to spend more to pay down the rates, essentially cap the rates to a lower rates. So is it kind of a good idea? You know, that question comes up at every single loan that we do, and we always discuss about it. So currently we're kind of looking at purchase about a 1.5% rate cap. We feel like that may be a 50-50 because anything lower than that is economically not feasible. Because essentially you would be buying 2 points rate for the money that you pay. Yeah.
So I'm thinking rate caps are getting more expensive probably because rate vol is getting higher. So rates are becoming more volatile. And that's actually part of the Fed's plan. So when the Fed is selling mortgage assets, that increases rate volatility. The reason being, so if you have a residential mortgage, you have an option to prepayment, right? To prepay it, right?
Yeah.
And so the Fed is kind of offloading these options onto the market, right? So in a sense, they were selling vol, but they're not selling volatility anymore. So I would expect that these options, these caps, and so forth, to go higher in the future. So I don't think it's so. Just to keep that in mind. Also, whether or not you think the rates will go higher is going to be a subjective thing. But if you look at all the commodity prices, where oil is, where copper is, aluminum is, where lumber is, it looks like they're going higher, and that means there might be more inflation, and that means the Fed is going to keep hiking rates. So that's one way to think about whether or not you should be trying to find ways to cap your exposure to rates.
Yeah. Okay. So that gave me some thoughts. So guys, if you guys are listening to it, for rate caps, it is a good idea if you're purchasing bridge loan, but you need to do a calculation on this. Obviously, when we're looking at $1 million purchase rate cap on a $25 million loan, for zero to cap it at 0.25%, that just doesn't make any sense because, essentially you'll be buying down like 2% spread for that. So currently we're looking at about a 1.25, 1.5% of rate cap because we feel like underwriting can absorb it. And that's the stuff that you should be thinking about when you're purchasing multifamilies and et cetera, using a bridge loan. It's cool. So we have some more questions over here from our listener. This is like super informative. I think, so folks, if you have any questions, just let us know. So David has asked, how does raising interest rate affect the $30 trillion debt payments? Very interesting. Yeah.
Well, I would make a distinction between debt payments. Is it a private debt or is it public debt? Now, if it's private debt, though, one person's asset is another person's liability, right? So if you have to pay more interest, that money goes to someone else, right? So it's a redistribution of money rather than, let's say, a difference in everyone else becoming poor, right?
But
that's how I think about the private debt side. So I don't really worry about that.
Yeah. And so I think he's referring to that $30 trillion that our country has owed the Treasury. Well, yeah.
That's not a problem because it can just print more, right? So
yeah.
No, seriously. So let's say, where does the government get its money to pay back its interest? It just borrows more. Or you can think of it as printing treasuries. So it's not a real constraint. The only constraint is inflation. So if you keep printing more money, you get inflation, right? If the Treasury keeps doing fiscal spending, it'll get more inflation. So no, it's not a real constraint at all. You just keep borrowing more money to pay it down. No, it's not. Listen, hyperinflation is not necessarily the case because it's hyperinflation. If you look past, it tends to be more of a political phenomenon. The government is failing, so nothing's happening. That's what happened in World War in Germany.
Right.
Before the World War, there was basically some threat of perhaps communist takeover, basically. So there was significant uncertainty in the government whether or not it would survive. That's how you get things like hyperinflation. but you could easily get, let's say, persistent 3, 4, 5, 6% inflation. That's very different from hyperinflation. It's just persistently high inflation, which, to be clear, many countries in the world have.
Definitely. And then that kind of leads me to kind of think about this a little bit more too. So back into the topics that you were talking about before, foreign investors, global markets. This is very interesting to us because I believe somewhere I read from Jeff Snyder's slides that he talked about the Euro market is a much bigger market. I can't remember how many X of the US market is. So, the global impact to our market is actually surprisingly bigger than US economy itself. So you mentioned before, because the world's going negative interest rate, so that could potentially doing some more, like encourage more global investors to invest in US Treasury. I still always wrap my head around it to say, like, who buys Treasury because the interest rate is so low. From our incomes and et cetera, we look at double digits IRRs, that these are our measures, but who actually buys Treasury? So you mentioned before pension funds, sources, perhaps insurance companies. And then from a global perspective, does other country also buys US Treasuries? For example, like China, is China a really big market to buy US Treasuries?
So this is what happens. So let's say you buy something from China, like, okay, so dollars go to Chinese company.
Yeah.
What does the Chinese company do? Oh, it wants RMB, right? So it goes to its bank and it sells the dollars for RMB. And what does its bank do? Its bank then basically gives it to the PBOC. And so that's how they have this huge, I guess, dollar savings account, dollar rainy day fund. That's worth $3.5 trillion. It's not all in dollars, but the total value is about $3.5 trillion.
Wow. Yeah.
And so, when we do a lot of trade, like we have persistent trade deficits with China, right? That's a lot of dollars that flow into China. And then what do they do with their giant dollar piggy bank? They just buy safe assets like treasuries because it's a safe asset. They're not going to buy Apple stock or something. They need something that's not too volatile and has no credit risk. So it's really this idea that treasuries are a form of money. You can just think of it as just a whole bunch of cash.
Gotcha. That makes sense. Yeah. That's good to know. And then I think somewhere, is it true that post 2008, kind of like the Euro market or the global, the demand for buying treasury has declined in the global market because the confidence to the US economy has potentially lowered?
I don't know if people buy treasuries whether or not they have confidence in the U.S. economy. I mean, if the U.S. economy does well, your treasuries don't earn you more money, right? If it was about confidence in the economy, you think about buying stocks or something, right? Because maybe if the economy does well, your stocks could go higher. But if you buy treasuries, whether or not you get paid back has nothing to do with, the confidence in your economy. It has everything to do with the fact that the government can just print more money.
Right.
So I think that is right. That maybe foreigners, I think what the data is saying, that the foreigners don't really increase the amount of treasuries that they buy. But that could be for a whole lot of reasons, right? For example, global trade. Maybe the global trade with the US is not as big as it used to be, or not growing.
Yeah.
Could be. And something else that is happening is that instead of buying treasuries, they buy agency MBS for slightly more return. So some of the sovereign funds do this as well. So it's not clear to me that that's the case, because treasuries are low yielding. You can buy agency MBS, you can buy corporate debt, and so forth.
Gotcha. That's good to know. We have a question from Tony. Basically, he said, so does Fed wins with higher rates while taxpayers lose with more expensive government debt payments? So the pretense to this is a big paragraph to that. So it's a double-edged sword. The Fed wants higher rates as a lever for a future recession, but raising Fed fund rates 7, maybe 9 times this year impacted short-term rates for US government debt. So does the Fed wins with higher rates while taxpayer loses with more expensive government debt payments?
That's a really good way. I would look at it. I would say that there's kind of been a paradigm shift in how the government works. And I say a paradigm shift in a very bad way. In the past, the government would spend money and it would tax its people, right? So when you have more government spending or higher government interest rates, then yeah, they're going to have to tax more to pay that. And so that's bad for the taxpayer. But what we see happening today, though, is when the government spends, it just borrows. It doesn't really increase taxes. And
it's not good political play.
Yeah, the government doesn't have, when the government doesn't have to tax to spend, the government can just print to spend. And that's what we do now. So you kind of have to ask, why should we pay taxes at all? Why don't you just print everything, right? So
exactly.
So I think the view that, this affects the taxpayer, it doesn't really, because, you just print everything. It affects the public through inflation, but not necessarily through taxes.
Yeah, inflation is really a hidden tax when we're kind of looking at that.
Yeah, that's exactly how it is.
Yeah. So I think somewhere else I have read that in order to increase the interest rate to curb the inflation at some point, like if we look at some historical data in the 70s, where that price fixing, the cap basically price, Nixon had that price fixing, what do they call it? A fixed pricing policy.
Controls.
Yeah, basically. So price controls. I don't think that exactly worked. But right after that, I believe
Volcker, it never works.
I believe Volcker has increased the interest rate to almost 18% to curb that inflation that was really high. And how high was that inflation back then? I can't remember.
It was double digits. It was really high.
And I think he raised it to 18% of interest rate, and that eventually brought it down. But some economists think that's not the reason that it went down. There may be some other reasons or whatnot. So in order to hike the rates up to that point, how high do you think really it's going to be effective and then curbing the inflation at 7.5%?
I think so. Hiking the overnight rate probably was not going to work as much. And I think what the Fed has been saying now is that they want to shrink their balance sheet. So they want to maybe massively let some of the treasuries roll off and maybe sell some agency MBS. So what I'm getting a sense is that they're raising rates not so much on the short end, but they're trying to get the 10-year up and trying to get the mortgage rates up. So they're going to try something different. And I think the thinking in that is that there's kind of a ginormous asset bubble, and hiking the short rates doesn't do that much, but maybe making longer term rates go higher would be more effective. So I think that's my sense of what they're trying to do. Whether or not so I think that's going to have a big impact on the asset markets, like let's say residential real estate or stocks. On the real economy, though, I'm not sure that has a big impact. I mean, if a real economy company, I don't know if just having to pay an extra 2% or something like that really affects your business so far. Know that if you're in an inflationary environment, by definition, your revenue is increasing, right? So that makes the debt more easily paid off.
Affordable, especially cash flow asset rents. If they're not creating rent control, which is a threat potentially, price fixing is a threat. But if the rents keep on going up, if you have a lot of reserve, I think we did do a modeling. We found that in our modeling, typically if you've hiked the rates of 1.5% to 2%, it didn't really impact the return too much. It does impact the cash flow, so making the debt a little bit harder to service. I think that's the real risk over there, but you can also mitigate that by having a lot of reserves, essentially. To make sure that you have cash reserves. Cash reserves can be used for many different purposes. So cash management is really a key. So we have a mortgage broker here that was asking, I have the investor cancel our loan last week due to rate increase. She asked, may I ask why? I'm guessing she's asking why is the rates going up? Otherwise, you got to talk to your investor why they cancel your mortgages. But it's probably not a really good idea, even if the rates are increased right now. We probably seeing the rates probably going to increase more, right? So if you're in the market purchasing residential housing, even though the rates are increasing, you should still be trying to lock down these 30-year rates because it's still historically low at this point. right, Joseph?
Yeah, no, I agree completely. Like the Fed is going to try to make the mortgage rates higher. That's what selling the MBS is all about. So it realizes that the housing market is kind of super on fire, and that's probably not the best thing.
Yeah, definitely. Another question, if inflation was calculated the same way as it was back then, we'll be in double digits right now. I think that's just a statement. There wasn't a question over
Yeah,
here.
listen, everyone has inflation. It's hard to calculate inflation because, everyone depends on where you live. Like when I used to live in New York, my rent is going up all the time. There's no way CPI was like 2 or 3%, right? No way.
Yeah.
And if you live somewhere else, it'd be a very different experience as well. So that inflation number is inherently flawed because everyone, lives a different place, buys different things. It's just an idea. But you're right. Some people are going to have much higher inflation than what's suggested by the CPI.
Because some of the rents that we are seeing over here, like in Phoenix market, for example, we're seeing almost 30% year-to-year rent increases. So we're talking about, yes, double digits inflation just from the rents perspective. And then we actually issued 20% increases on one of the community that we have bought because it's really severely in the market. And then all our tenants actually took the increase because there's no other options that the housing they can go into, because our 20% hike still puts them at the lower of the market per se. Yeah, so it's pretty crazy. But if you're living in like West Coast of New York or so, like maybe in the last 2 years, the inflation isn't as bad. I don't know, like you used to live there. So because the rent increases, I think across an apartment, across the whole country is about 15%. So when you look at that benchmark, people would say, oh, New York is a recovery, like our rent increases of 5 to 6%. You're way below the curve compared to the average of apartments in the US.
They all moved to Phoenix.
Right. And Dallas and Houston and San Antonio and Austin. Cool. So Tony has another question. So QT and rate hikes at the same time. Is this the first time they ever done that?
So first time they've ever done this so aggressive. The last time they did the QT, it was well when the rate hiking cycle has already been going on for like a couple of years, and then they started QT. This is the first time they've ever been so aggressive in the very beginning. So this is a very new thing, and it's something that we really have to watch, especially if you're investing in like risk assets, like stocks, because they're going to do two things. They're going to be very aggressive in their rate hikes. Now, front loaded. It's going to be a few, anticipating a few this year, and they're going to be very aggressive in doing QT. Last time they're doing QT, I think 50 billion a month, not a big deal. This time it's going to be a lot more than 50 billion a month. Well, actually, the last time they did QT in 2017, I think they started with like a slow 10 billion a month, and they worked their way up to 50 billion a month as a maximum. This time, the minimum that they're going to start with is 50 billion. So it's going to be a lot more aggressive than last time. So this is definitely something that's new, and it's probably going to have a meaningful impact on the market.
And why do you think that they're doing this so aggressively this time? Is it because the inflation
rate
is
at 7.5%? What's going on, right? So the Federal Reserve for like 10 years, inflation is too low. Inflation is too low. And then inflation is 7.5. All the prices are going higher, and rates are still at zero. So that's not normal, right? If you're a responsible, central bank, you look at 7.5% inflation and you don't be like, oh, I think interest rates should be zero. That doesn't make any sense. So they know that they're kind of really behind, that they're really, really, really messing up, and so they want to catch up.
Gotcha. So I love that you mentioned about the stocks. I think that's a lot more volatility. If you look at rate hikes increasing, I love what you just said over there. So what you just said over there is basically, if I recap it, the rate increase by the Fed is going to make a much bigger impact to the stock market than if you're holding a stable assets, such as the mortgage rate is going to go up 2%, 3%, 4%. But even the mortgage has gone up like 3-4%, there's still a possibility that you can service your mortgage as long as you have good cash reserves. However, with the stock market, the speculation of the rate increase can already crash the market in some ways. And then when it actually increases, that stock market will be a lot more volatile. Where do you put your best money? I'm concluding over here is like, if you have cash flow asset, your cash flow may be lower if your rates are kind of going higher, but it's probably still the best place to put your money at versus, maybe, you need to look at your portfolios in terms of stock holdings and et cetera to make that potential shift to some of these cash flowing assets. Can be single family, can be multifamily, can be commercial spaces, whatever that has a real assets. I think it's a little bit more stable over there.
Yeah.
How is interest rate going to impact crypto market? This is a very random thought I have because we kind of talked about different kind of assets. Yeah.
Crypto is actually obviously a lot of interest. This I don't actually know what drives crypto markets. It kind of goes up and down.
Yeah.
I think what you really want to be worried about is regulation, because that's coming and it's probably going to have a very big impact on the crypto market. So it's not going to come from the Fed, it's going to come from the SEC. Now, what you want to keep in mind globally, people throughout the world, they're coming up with their own central bank digital currency. The government wants to have its own CBDC, right?
Yeah.
It won't like to have competition. So you want to keep that in mind. So that's something to be, I think, very mindful of. Right. I understand that having CBDC. Listen, I saw what happened to the truckers in Canada. The government goes, they don't like what they say, so they go and they take their bank account. It would be great to have some kind of crypto to be able to sidestep that. But the government controls all the banks and has a lot of power. So it's if they wanted to shut something like crypto down, they could.
Yeah, definitely. And then we kind of see that happening in China, right? Like, so China has basically shut down the Bitcoin crypto over there, which essentially, you can still trade it. You can have an offshore account, but it doesn't do any good if you can't trade for goods.
And they shut it all down after they came up with their own, right? They have their own digital RMB. Now they're like, everyone else get out. So
right. Yeah,
you can easily see that happen in any country.
Right, exactly. Okay, so David had a question: what could cause them to stop raising rate? He's talking about Fed, the GDP inflation target. What is the target for them to say, okay, now we're gonna stop raising the rate?
About inflation.
Okay.
So inflation has to be on the trajectory to go down towards 2%. I don't know if it's going to do that. I mean, listen, if we have a conflict in, let's say, Russia, Ukraine, that is highly inflationary. It's inflationary because it sends commodity prices much higher. And, if you have that happen, inflation is not going to come down. The Fed perceives, and they've said this many times, it perceives the public to be in good financial shape. And they're right. Household net worth is the highest it's ever been. Everyone's property, their homes, their stocks have, gone to the moon. So that makes them feel that that makes the Fed feel that the public can withstand some volatility in the stock market.
Gotcha. Which is really interesting because, could this ever happen with inflation? They couldn't bring it down because shortage of supply is really a big root cause for the items to cost a lot more. Right at this point, because
it still works. It just destroys demand. So that's the bad thing people don't want to talk about. It works by causing a recession.
Okay.
And that's what happened in the 70s, and that might be the only thing they can do now.
Gotcha. So essentially, you see that it's possible there may be a recession that's coming, maybe promoted by the rate hikes, et cetera, causing stock market to crash.
Very high prices, right? Very high oil prices, commodity prices. That takes away income because you have to pay more of your income to these producers elsewhere. So that impacts demand.
Yeah, that makes sense. Great. So everybody kind of head out to a possible recession that's happening, right? So if you're buying a property and selling, if you do a flip, these are stuff that you got to watch out for. Make sure that stuff that you buy have a good base price. Essentially, it has to be really below the market deals that you're buying, or the value add stuff. It's a little bit more dicier currently, but also we want to make sure to run all your stress tests. You could buy a value add property if you have a lot of cash reserve potentially, because the cash reserve is another tool that you can use. Because I do buy for my own projects, I bought a 10-unit property. It's literally a huge value add because we're renovating 5 out of the 10 units. So certainly you're not positive cash flow, but because we have reserve over there, this is as part of the underwriting and planning for it. When we image out of it, it's going to be a cash flow asset. So these type of stuff is that you got to think about, be over leveraged. So what the next question is, how quickly will inflation react to the rate increase? I think Joseph, you mentioned it before, by just hinting the rate increase, it's already impact the market. So
Yes.
Today's mortgage rate, when we're looking at that, kind of like Annabelle was asking before, why is the rate has increased even though the actual hike hasn't really happened, but it's due to the hinting, that the market's
Yes.
already self-adjusted.
The market prices it in. Yeah, the market is adjusting. And that's why you see, let's see the 30-year mortgage rates going up so much. It's the anticipation. So
Gotcha. And then, so with that anticipation, because Fed has talked about hiking rates 3 times this year and 2 times next year. So do you think that rate already kind of baked in these, 1.5, 150 base point essentially? Yes. So really when they're announcing the rate hikes, what's kind of funny that's going to happen is potentially that rate actually wouldn't increase anymore because it was already anticipated.
Exactly.
Got it.
So what would happen though is people will be listening to what Powell says, hinting, wanting to know that if he would hint more rate increases next year or later in the year, then the 2-year rate or something could go further up. So they want to know if there's been a change in what he's hinting at. Is the trajectory going forward even higher than last time? Yeah,
got it. Cool. So I think we're almost out of time. This is super helpful. Guys, if you have more questions, I think we'll take 1 or 2 more questions over here. But otherwise, I want to kind of share my screen really shortly, just to kind of give, because I think some folks are investors, a little bit hints on here. So here's a loan documents that we have obtained from one of our lenders. This is a bridge loan potentially. So how does the SOFR actually works over here? I had this questions for Joseph before. Here's a loan term that explained all the rate cap agreements and etc. But the interest rate now, you can see starting from January, everything is based on SOFR. So I want to kind of read this paragraph and have Joseph kind of like dive into a little details on what CME is, what kind of SOFR, because when he was asking me, he's like, what kind of SOFR do they based on? I have no idea. So we brought it up this long term and then kind of looking through this. So basically replacing Libor, we're using SOFR, and it basically said the spread is 340 base points. And then there's a 10 base point. So that means there's a 3.5% loan, still very cheap, right? But this is a floating rate. So it will go up as the SOFR goes up. So what is CME? What does that mean? So number 2 over here says CME terms of SOFR on the business day immediate prior to. So essentially, you don't really get to there's no rate lock or anything. But in commercial, we don't really do any rate locks, etc. Even if it's a fixed rate until 48 hours before the closing actually happens. So if it's a fixed rate thing, 48 hours before closing, that's when they do the rate lock. So even though when you sign up the rate, it could be a lower rate, but later on it could move up, right? And then the proceed could be impacted as well. But in this case, this is a floating rate, so it didn't really matter. What is CME and what kind of different SOFR are there?
Yeah, so I think this is a great example because it illustrates how different SOFR is from Libor. SOFR is an overnight rate. So let's say SOFR is 5%, 5 basis points today. That means that yesterday, everyone borrowed in the overnight repo rate at 5 basis points. So whereas Libor, if Libor is, let's say Libor is 1% today, that would be the interest rate you would pay to borrow money for the next 30 days. So SOFR is what happened yesterday, and Libor is what happened to borrow money, let's say for the next 30 days. So one is forward-looking. That's a huge difference between SOFR and Libor. But everyone wants to have a forward-looking rate. So what happened is that the Chicago Mercantile Exchange, which is the CME, they're trying to build a forward-looking SOFR based on derivatives. So there's a, let's say there are SOFR futures trading, and they try to estimate, what's going to be a forward-looking SOFR for, let's say, the next 30 days, so that it's more comparable to Libor, which is basically borrowing for the next 90 days or 30 days, depending on your term. So this means that, you're going to go to CME and they're going to tell you, and they're going to calculate this term SOFR for you based on the derivatives.
Gotcha. And then, so there's other measures too of SOFR, like what are some other, different types of SOFR?
So SOFR, purely SOFR, is just what happened in the overnight repo market yesterday. Now, the Fed has all sorts of things to try to customize this. They have, let's say, average for the past 30 days, past 90 days, or the CME, you can have, forward looking for like the next 30 days, things like that. So you want to see, and also there's differences in how they're compounded. For example, let's say there's a weekend. Do you use the rate on Friday, or do you use the rate on Monday for Saturday and Sunday? Things like that. Gotcha. So some fine print, just take a look. It does make a huge difference, but I know many of you guys have a lot of money, so maybe it does.
Not really. I think 1% interest rate is quite a bit different. So cool. Also, last question we have for you is like, how do you find more about you? How do people kind of read to get more educated about you?
Thanks for asking that. So right now what I do is I teach people about how the financial system works in things like SOFR and so forth. So I have a website called fedguy.com where it's more targeted towards investment professionals, where I talk about what's happening in the market. But I also have a book. It's called Central Banking 101. It's on Amazon. It teaches people basics about banking and the monetary system. And I think that's a really good foundation for understanding how some of the things that I'm talking about, how repo market works and so forth. And if you're looking for more advanced topics, I also have online courses that I have on my website as well.
That's awesome. Yeah, and then I started reading that book. It was a really, really great book. So you definitely want to kind of look it up at Joseph Wang, the Central Banking 101. I think it's a really great book that gave you a frameworks and the plumbing if you wanted to know what the plumbing of how that whole system, economy system works. And I really think you should know, because if as investors, you should know how the monies are being traded, how the borrowing are happening, what is your lender thinking, right? And then be forward looking in terms of projecting and what type of loan that you should be getting into, that type of stuff. So definitely check him out. Also, Joseph can be found on the fedguy.com.
Yep, fedguy.com.
Yeah, fedguy.com.
And I'm on Twitter. You guys could, if you send me a message, I'll reply. It's at fedguy12.
Awesome. Cool. Well, thank you so much for the session today. And that this is like a really wealth of knowledge. It helped me understanding a little bit more and helped me solidify that some of the strategy that we have for the rest of the year, what we purchase and etc. Thank you so much, Joseph, for your time.
My pleasure. It was great to see you again, and great to chat with everyone here.
Definitely. All right. Talk to you soon, guys.
Bye.
Bye.